I'm not 100% convinced that the crisis that's happening over in the other part of the world isn't part of this whole transition. Well, I would definitely be securing any wealth that I hold in the system, with gold and also physical silver. Okay, so you definitely need those in your possession. We are getting so many true signals that not only are we heading into a recession, but there's no doubt in my mind, and I'm really sorry to say it, but I think we've begun the hyperinflationary depression. That's the next step. Well, number one, and I think a good differentiation between all of those is simply the speed of the inflation and the level of economic growth. But here's the problem.
Yeah.
The government and the central banks, rather, have really used a big part of the inflation to say this is what's happening with GDP. So the fact that we had in the first quarter, it declined by 1.25% when we have inflation officially running at 8.5% is frankly very worrisome. Now, why they want to say it's noise is because of all of the checkable deposits that are in the system. So the theory is that the consumer is really strong. Well, I think it depends on which part of the economy you're in, because let us not forget that K-shaped recovery. And also with the dollar against other currencies being really strong, right? What does that do to our exports versus our imports, right? Makes imports look cheaper. But it's all really a game, and I don't think this is noise. They will not be successful with the tightening because, number one, it's a different kind of inflation. It's a supply side inflation versus a demand side inflation. And on top of that, even if they do a series for the rest of the year of 50-point rate hikes, the interest rate will still be below the level of inflation, even their reported inflation, which of course is when you're out there buying food and anything else, it's much higher than that 8.5%. I'm not 100% convinced that the crisis that's happening over in the other part of the world isn't part of this whole transition. Because they're all members of the IMF. They get together regularly. We've watched a synchronized deflation. Now we're watching a synchronized inflation. We watched synchronized money printing. Everything was synchronized. And all of a sudden it's not. And we're going from crisis to crisis. And you know what I'm curious about? And maybe you've spoken to somebody that knows about this. The lockdowns in China over the Omicron virus, I had it. It wasn't really, if I hadn't tested because somebody else I knew had it, I wouldn't have even known. It was a slight stuffy nose. Maybe all of a sudden, all of this division has come about, but I've just seen too much synchronization for too long to be absolutely convinced of that. The dollar just hit a 20-year high against key trading partners. So the yen, the euro, etc. Well, at the same time that the inflation is raging here in food, in housing, in really everything, the services sector, right across the board. Well, how come if our dollar is so strong, how come our purchasing power is so weak? Well, see, and that's the whole point, isn't it? If we truthfully have 3 cents left and you look at the rate of the devaluation, so the purchasing power declining, that's really the trend. But if they can make the stock market look like it's high and say, look at this is making new highs, or they can make the dollar against other currencies, because that's what that refers to, then people are going, oh, well, the dollar is strong. It creates,
a perception.
Oh, definitely. Yes, absolutely. But in the reality is that what matters is what you can buy with those dollars. And I think that now that it's running fast enough for people to actually notice it, it's a big problem, because what are they really concerned about? De-anchoring of inflation expectations, not inflation itself. You know, what I know, timing is the biggest challenge, but what I do know is that a lot of things have to shift in 2023, including somewhere around 610 trillion in notional derivative contracts that are tied to LIBOR shifting into SOFR. And they're forcing that shift, even though when they ran that test in October, I think it was 2019, might have been 2020, I'm sorry about that. But when they ran that test with 80 trillion, it was a big fat fail. And you know that because it got really silent, and then 3 weeks later, they postponed it until 2023. And LIBOR does not work like, or rather SOFR does not work like LIBOR. So, you know, I hope we have more time than that, but I could definitely see a crisis maybe a little bit before 2023 or in 2023. People that love crypto and the people that love gold they have the same mindset, and I get it. This is proven, and you know, I'm sorry, but when I read that 1996 NSA white paper, which is a government agency on how to create a mint, describing this whole crypto market, and I look at Wall Street and I look at the level of adoption, one thing I know, I'm not an engineer, I don't understand cryptos, but I have studied currency life cycles and their transitions into new currencies since 1987. And every single time, I mean, there are repeatable patterns. And a key one that I would say is that they allow the general population, to make money as they're making this transition so that people go along with it. Look at the roaring 20s. Look at the greedy 80s. And look at the 2020s. That's a common thread. Because it's the only financial instrument that runs no counterparty risk, and everything that we're dealing with is all of this counterparty risk. It's the only financial asset that truly is invisible. Once you hold it, you own it outright, and it is proven for 6,000 years to fight inflation. It is proven to be, the Bank for International Settlements, gold held at home runs no political risk.